Imagine running a retail store where like almost all of your inventory is handed to you completely for free.
And on top of that, a massive chunk of your staff shows up every day to work for zero pay.
Right, so on paper, that sounds like an infinite money glitch. You would think a business model like that is entirely bulletproof. But what happens when that exact highly subsidized operation suddenly starts going broke?
Well, we are watching major storefronts with those exact advantages frantically closing their doors right now.
While at the exact same time, the broader U.S. economy is pumping out a hiring boom so massive that it is actively making Wall Street panic. If you are listening to this and wondering why good news for American workers makes bond traders sweat through their suits, you are definitely not alone.
I mean, we are looking at a bizarre financial landscape today. The headline numbers tell one story of unbridled growth, but the underlying mechanics reveal businesses fighting intense, localized operational costs.
Exploring the sources today perfectly illustrates that uneven pressure. The central tension here is that there is no single unified global economy right now, is there?
Not at all. We're looking at distinct, hyperlocal pressures forcing completely divergent reactions from different sectors. The mainstream headlines focus on raw job creation, which looks fantastic on the surface.
But when you isolate the incentives, we find a much stranger reality. Businesses are aggressively staffing up to capture very specific spikes in consumer demand.
While simultaneously suffocating under the weight of their own traditional corporate overhead, the data sets today show us how global events ranging from a major sporting tournament to the ongoing war in Iran are dictating how a factory in Somerset or a restaurant in Chicago manages its balance sheet.
Um, let's look at the May jobs data, because the official figures just dropped, showing the U.S. economy added 172,000 jobs last month.
Which absolutely shattered Wall Street expectations. I mean, those were sitting somewhere between 85,000 and 105,000.
It is a massive upside surprise. The overall unemployment rate is holding steady at 4.3%. And, this is not just a one-month anomaly.
No, the figures for March and April were just revised upward by a combined 93,000 jobs. When you factor in those revisions, the three-month average is running at roughly 188,000 jobs.
That is a relentlessly strong labor market that simply refuses to cool down. But tearing apart the anatomy of those 172,000 jobs reveals a highly concentrated growth pattern, right?
Very much so. This is not broad-based economic expansion where every industry is hiring. The surge is intensely localized. Leisure and hospitality added 70,000 jobs in a single month.
Oh, wow. And to put the scale of that into perspective for the listener, the average monthly gain for that sector over the prior year was just 14,000. That is a five-fold increase.
It's massive. And within that specific hospitality sector, food services and drinking places alone accounted for 48,000 new hires.
Which makes total sense when you look at the underlying cause driving this specific boom. It's raw anticipation. Businesses are aggressively staffing up their service operations ahead of the Summer World Cup.
Right, which is being jointly hosted by the U.S., Mexico, and Canada. Local government also saw significant gains.
They added 55,000 positions, likely for infrastructure and event management, while healthcare contributed another 35,000 jobs. Thinking about those specific sectors, the current economy closely resembles a massive sporting venue getting ready for game day.
That's actually a great way to look at it. The front-of-house operations, the ticket takers, the concession stands, the hospitality suites are frantically hiring anyone they can find.
Just to handle a massive influx of anticipated consumer demand. But while all that chaotic growth is happening in the public-facing areas, the back-office management is quietly downsizing, clearing out desks, and shrinking their footprint entirely.
Because they're responding to a totally different pressure. The employment data from the financial sector provides the starkest contrast to that hospitality boom. Financial activities actually shed 22,000 jobs in May.
And that brings total sector losses to 107,000 since its employment peak back in May 2025. These contractions are highly specific, hitting insurance carriers and commercial banking the hardest.
We are witnessing an environment where physical, service-oriented labor is at an absolute premium due to this global sporting event, while white-collar financial services are pulling back aggressively.
Higher capital costs and a significantly slower volume of commercial deal-making are really taking their toll. And those higher capital costs bring us to the weirdest part of this whole equation: how the broader markets digested this supposedly fantastic labor report.
Well, average hourly earnings are up 0.3% for the month and 3.4% year over year. Consumers are making more money.
which sounds great for the average person trying to pay rent and buy groceries.
Yeah.
Yet bond traders reacted to this hot jobs and wage reading with immediate hawkish panic. Wall Street looked at robust job growth and saw a massive threat to their borrowing costs.
Because the bond market operates as a ruthless, forward-looking mechanism for interest rates. The rate-sensitive two-year Treasury yield spiked about 10 basis points to 4.14%.
In equity futures across the board, the S&P 500, the Nasdaq, the Russell 2000 all drifted lower. For anyone unfamiliar with the terminology, a basis point is just 1/100th of a percentage point.
So a 10 basis point jump might sound tiny, but in the world of global finance, it is a significant, noticeable repricing of the baseline cost to borrow money.
When traders see higher wages and aggressive hospitality hiring, they anticipate that consumer spending will remain robust, and robust spending sustains inflationary pressure throughout the broader economy.
Exactly. Market data now shows a 58% probability of at least one rate hike by the December Federal Reserve decision. That entirely eclipses the previously held expectations of a rate hold or a rate cut.
So the two-year Treasury yield jumping is a direct mathematical assumption that the Fed will have to keep monetary conditions restrictive to forcefully cool off this resilient labor market. But my skepticism here centers on whether this market reaction is genuinely about the labor data alone.
You're thinking about the timing of the next central bank move.
I am, because the Federal Reserve's June 16-17 meeting is right around the corner. Crucially, this is the first meeting chaired by Kevin Warsh since he succeeded Jerome Powell in May.
Right. Testing a new Fed chair is a classic, almost predictable market maneuver.
Are traders just nervously testing the new central bank leadership? They might be using this hot jobs report as a convenient excuse to push bond yields higher, essentially daring Warsh to prove his inflation-fighting credentials right out of the gate.
Well, markets consistently price in a substantial risk premium when central bank leadership transitions. It is a well-documented behavioral pattern. Warsh is inheriting an economy that is actively defying traditional cooling mechanisms.
So traders are demanding immediate clarity on his personal tolerance for prolonged inflation versus his willingness to risk triggering a recession to stop it.
By driving up yields now, the market is effectively forcing the new chair to address the glaring discrepancy between a booming consumer service sector and a contracting financial sector.
The upcoming meeting will establish the baseline communication style and the policy threshold for the Warsh era, making this immediate data reaction doubly volatile and highly performative. If you enjoy untangling these market mechanics, you can find financial candy, brain candy, and classic audiobooks at clearingaratio.com.
You know, the reality of those elevated interest rates and persistent inflation eventually travels from the abstract world of bond trader terminals straight down to physical storefronts.
In a related development regarding rising operational costs, looking at retail operations in the UK offers a stark look at how these fixed costs are fundamentally altering business models, even for organizations that do not operate on traditional profit motives.
The mechanics of corporate finance dictate that prolonged higher borrowing costs inevitably filter into the daily operating expenses of brick-and-mortar retail.
Which explains why the British Heart Foundation announced they are planning to close roughly 150 of their 640 charity shops by March 2028. This brings us back to the economic paradox we mentioned at the start.
Right. A charity retail model relies heavily on free, donated inventory. Furthermore, the workforce is heavily subsidized by unpaid volunteer labor.
So how does a storefront with practically zero cost of goods sold become financially unsustainable?
The fixed cost floor of operating a physical building has risen so dramatically that it completely overwhelms the advantage of acquiring free inventory. A major charity operating a physical high street storefront still has to service rapidly rising commercial energy bills to keep the lights and heat on.
Plus, the regulatory environment has increased the baseline cost of core employment. Retailers are dealing with increased employer national insurance contributions,
Which are essentially mandatory payroll taxes that employers must pay to the government for every worker.
On top of that, there are higher minimum wages for the mandatory paid managerial staff required to actually oversee those unpaid volunteers.
The British Heart Foundation's decision illustrates a brutal mathematical reality. When utility rates and mandatory payroll taxes cross a certain threshold, the traditional physical footprint becomes inviable, regardless of how wide the theoretical retail margin is on a donated pair of shoes.
The strategic response to this fixed cost pressure reveals a broader structural shift in how retail spaces function. The British Heart Foundation's overall corporate finances actually remain perfectly healthy.
They are still generating strong, ongoing fundraising and legacy income from donations. They are not failing as a charitable entity.
They are specifically excising the small physical storefront from their operations because the math no longer works. Cancer Research UK is executing the exact same defensive maneuver. They are closing around 190 high street shops by April 2027.
But at the same time, they are opening 12 massive out-of-town superstores. They are actively trading multiple small, expensive, energy-inefficient urban leases for fewer, larger suburban footprints.
They are adapting to reduced footfall in town centers and intense consumer competition from online resale platforms like eBay and Vinted, which have completely changed how people shop for secondhand items.
Consolidating into out-of-town superstores completely changes the unit economics of charity retail. By moving away from the traditional pedestrian high street, they secure significantly cheaper square footage.
And they also consolidate their paid managerial payroll.
Right.
Instead of paying 10 managers to run 10 tiny shops, they pay 2 managers to run one massive warehouse.
Crucially, they create a destination shopping experience that justifies the travel for consumers. This mirrors the broader consolidation trends sweeping across all commercial retail sectors.
These charities are recognizing that the traditional function of the high street, relying on passive foot traffic, walking past small storefronts, no longer generates enough daily revenue to justify the escalating energy and tax burdens.
It is a highly calculated retreat designed to protect their core operational mission of funding medical research.
On a similar note regarding those rising operational costs, while the retail sector manages them by retreating from physical spaces, industrial manufacturers are fighting those identical pressures using an entirely different financial mechanism.
They are relying on aggressive capital expenditure. The escalating cost of commercial energy, fueled heavily by the ongoing geopolitical conflict in Iran, is pushing companies to seek permanent structural solutions to their utility bills.
In Somerset, Pneumatic, the manufacturer famous for producing the iconic Henry vacuum cleaner, just executed a £1.5 million investment to install 2,672 solar panels in a massive field directly behind their factory.
They aren't shrinking their physical footprint to save money. They are actively buying their way out of the volatile energy market.
The driving force behind this level of capital expenditure represents a critical shift in corporate psychology and internal capital allocation.
For the past decade, large-scale corporate renewable projects were largely championed by sustainability managers focusing on carbon emissions targets and public relations. Today, these massive purchases are authorized directly by finance directors who are driven by raw mathematical necessity.
Total UK commercial solar installations are up 11% year over year. Government figures show an astonishing 27,000 new commercial installations in March 2026 alone.
Which is the highest level since 2012. Companies now view commercial solar arrays not as green initiatives or marketing tools, but as hard financial hedges against unpredictable geopolitical energy shocks.
Well, the commercial return on investment for solar technology is inherently superior to the residential math, which makes these corporate investments incredibly lucrative.
If you look at a typical family home, it draws its heaviest power loads in the early mornings before work and the evenings after sunset.
That is completely out of sync with peak solar generation hours. But industrial operations, like a vacuum factory running automated, robotic plastic molding, consume their maximum electricity directly during the workday.
They are drawing their heaviest power loads exactly when the sun is shining directly on their panels.
So Pneumatic expects to see a full financial return on its £1.5 million investment in under 4 years. By deploying that capital now, they are essentially prepaying for a decade of electricity to permanently escape market volatility.
The concept of prepaying for energy fundamentally changes a company's balance sheet risk profile. When Pneumatic's financial director calculates a sub-4-year payback period, they are effectively locking in a fixed, predictable cost of production for the foreseeable future.
If global conflicts push natural gas and grid electricity prices significantly higher over the next 5 years, Pneumatic's manufacturing margins remain entirely protected because they manufacture their own power on site.
We're seeing this across the supply chain. Laithwaite's wine warehouse in Gloucester is experiencing a simile installation. Their 7,710 panels are already powering their entire automated facility even on cloudy days.
And they are generating excess power to sell back to the national grid. These massive capital investments transform a highly unpredictable liability monthly energy bills dictated by international conflict into a predictable earned asset that strengthens the company's long-term valuation.
Today's sources reveal that there isn't a single global economy right now, but rather distinct pressures moving in different directions. Analyzing a single metric like the national unemployment rate or retail footprint data provides an incomplete picture.
We are observing an economy defined by intense localized adaptation. The U.S. hospitality sector is experiencing a massive consumer-driven hiring boom triggered by a highly specific sporting event.
While operating completely insulated from the heavy contraction happening in the financial services sector.
Meanwhile, traditional UK retail models are buckling under fixed utility costs and strategically moving to cheaper out-of-town superstores, while heavy manufacturing spends millions on private power grids to survive the exact same inflationary environment.
Every sector is rewriting its operational playbook based on the specific, localized pressures threatening its margin of survival.
When major geopolitical events permanently raise the baseline cost of running a business, the companies that ultimately thrive aren't necessarily the ones selling the highest volume of product. The real winners in this highly segmented landscape are the organizations that most ruthlessly control their utility bills, their real estate footprint, and their operational overhead. That's financial candy for Friday. We'll be back Monday. If you need something to listen to this weekend, check out Brain Candy, Debate Candy, or Sunday Candy. Have a great weekend.